on the short end is going to pay you. You're not taking any risk, and you have the flex to do something different. If we get some, I don't know if we will, but if we get some real dovish language from Chair Powell next week, then all of a sudden it's off to the races and it's go time. So I think you want to have liquidity. You want to have an ability to flex and do something. But I don't think it's binary. I don't think it's cash or something else. I think it's a mixture. And we're hopeful that Powell gives us a signal that it's okay to step a little bit out on the risk spectrum.
Does dovish language from Powell next week, does that just take the Fed out of the equation for the foreseeable future because they're not going to do anything on rates? They're still going to be doing QT, but they're not going to up it. Is that what you want?
Yeah, dovish language is like nirvana. He's not saying it, right? All we can hope for is we're thinking about. Yep. So we're prepared for him to be.
But thinking about cutting or thinking about being done?
Being done, yeah.
Okay, yeah.
Our view is they're done.
Yeah.
He's not, language is free, right? He can say whatever he wants in the presser, and that's what he's going to do. He's going to be just as hawkish as he's been and scare the heck out of everyone in the market, and that's just, we have to live with that. So our expectation is they're done, but they won't tell you they're done until well after the fact. And that's why we're talking to clients about T-bill and chill for now, but get ready to turn the dial. And there's not going to be a green light. He's never going to say, hey, everybody, we're done. He's going to hint and hint and hint, and you've got to read through the lines. But if you're a long-term investor, that's less important. It's more important to know that we're almost at the end. Whether we're right and he's done, or somebody else is right and they've got one more, we're really close to being done.
Yep, that's kind of the call here. The question is, how close? And so let's just focus on something a little bit more fundamental. We're smack in the middle of earnings season here. Any takeaways that you guys are focusing on here, or what are you looking for to hear from these management teams?
Yeah, it's still early. So our earnings scorecard isn't yet. I wish I was back here in a week,
right? Because
a busy week next week, not just the Fed meeting, but a number of really big names. I think the biggest learning that's emerged from the early part of the earnings season is how much companies who give poor guidance are getting beaten up. The guys that are delivering solid results, they're even getting the beats, and the majority are beats. The beats are ahead of what they've been over the last couple of quarters, so feel good about that. But boy, the misses are getting clobbered. And so the guidance, when the guidance is weak, either in printed or in the calls, look out. It's tough.
I get the same feeling. I get the feeling that if you meet or beat, you're okay. It's no big deal. But if you miss, they're going to take you to the woodhouse.
Yeah, it's always been that way. But I think right now, just in your opening comments, what do you do with this market? I think a poor guidance or someone coming out and just saying, look, I think next year is going to be tough, or even the first half of next year is going to be tough. You're right. You are getting taken out.
We've seen some big beats. If I look at S&P index EA Go on the terminal, 245 out of the 500 have reported on the S&P. Earnings surprise, 7.4%.
Yeah.
So big beats. And if I look down the list of who's done it, consumer discretionary is ripping. They're up 15% over expectations. And if you look at just growth over the same quarter last year, it's also huge. 5.8%, 5.9% in terms of earnings growth. And if you look at consumer discretionary, 54% in terms of earnings growth over the same quarter last year. If you look at communications, 35% over the same quarter last year. So they're doing well. Are we going to see these kind of earnings seasons continue into 2024? Are we going to see, 5, 6, 7% earnings growth?
Well, first I thought you were going to ask me, why isn't the market up on this incredible earnings season?
I know why the market's not up. You got yields that are off to the races, right? Yeah. Offering, as you say, T-bill and chill.
Yep.
You got a lot of competition from yields. Plus you've got a rising dollar. Plus you've got rising oil costs. So,
yeah, no, it makes sense. It makes sense that we're bouncing around. And I think you also have this specter of a recession out there. So look, there's two things that are going on. One is the sell side is talking about earnings, and they really haven't budged their numbers much. We think that it's frankly the buy-side firms that aren't publishing, that aren't telling you what they're doing with their numbers. They've taken them down. So we would expect to see some slowdown in earnings over the next couple of quarters. By the way, macro perspective, don't think we're going into recession, think we get through. But earnings will slow from here, whether that's this quarter or next quarter or Q2, we'll see. But it's definitely earnings slowdown from here.
By the way, is this normal being in a red hot economy looking back, but everybody kind of biting their fingernails and worrying about a recession around the corner. Is that normal?
Yeah, it's there's so many people out there that don't even know what a 5% 10-year looks like. Right, that people have said, "Oh, wait, can the 10-year really go?" I mean, there's some people that think that's almost like an artificial ceiling. That's as high as it can go. Yes, this is normal. Even if you go back to the early 2000s when the economy was steaming, not knowing the GFC was on right around the corner, but there was concern around, have we overcooked this thing?
I go on challengertalk.com. It's a forum for Dodge buyers.
Yeah,
and
I'm not on them.
And
not familiar with that.
and there'll be a headline, Challenger sales are down, and somebody will be like, yeah, because this economy's in the crapper, and I'm like, really?
Yeah.
5% GDP growth, 3.5% unemployment. This feels like a bad economy to you?
Right.
It does.
Yeah, and look at the participation rate is creeping up, and we're, like you said, wage growth has been consistent. Consumers are spending. I think what that comment is a reaction to is the savings rate coming down. So coming out of COVID, all that money pumped into the system. Everyone had bloated balance sheets up and down the wealth spectrum. Now it's really the upper end of the wealth spectrum that has the dollars, and the lower end is spent through, and that's why you're starting to see credit card numbers pop up. So there really is a tale of two cities going on. At the upper end, everyone is comfortable T-bill and chill. At the lower end, we've seen a reduction in savings, and that's starting to, you can feel it.